Hello, welcome to the first video of the Investor's Opinion. Welcome to this new channel that is designed to give financial knowledge to individuals who are seeking it, especially New Zealand. So that the market, being such a lucrative place, especially over the last 10 years, may be a fantastic opportunity to make money, or to make your money that you have now make more money. I know many people who save money into a savings account and just leave it there. And as you know, at this period of time, 2020, interest rates are at a almost record low. So the best option for you to make the most money is to currently buy equities, i.e. stocks. Now this is what this video is all about. So I guess we'll start with what is a stock. A stock is a share. It is a portion of ownership of a company. So let's say there's 100 shares of Apple shares on the market for $1 a share, just hypothetically. That share is 1% of the company. So if you owned 10 shares, you would own 10% of that company. Now, if the company was to appreciate in value, $100, your shares would therefore be worth another $10. So your 10 shares would now be worth $2 each, $20. Now, what is the stock market? The stock market is where people can buy and sell from and to. It used to be you'd have to go to Wall Street to do this, i.e. you'd call a broker, the broker would sell you shares at the set market rate, you would order that, you would pay them, they'd take a commission, and they would lock in those shares for you. However, today there's now a new digital broker. Then one of the reasons why I've created this channel, New Zealand's now access to the US market has become much more user-friendly. These new digital brokerages have incredibly low fees, they're really user-friendly. Expand further to invest our money into the US stock exchange, essentially, to invest in these equities that, like Facebook or YouTube, Google. The second question I guess you'd probably be asking right now is, why would you invest in company shares? So you can let your money make you money, essentially. That's the main reason why you want to invest your money. It's your savings, and you want that to increase value. You want to be able to make a return on that money, as opposed to it just sitting there doing nothing. The more you put into it, the more return you will get. So there are two types of ways to make money from stock. One is dividend-based investing, and one is growth. Now, dividends, they are where you own a portion of a company, their shares. So you own, let's say, 10% or 100 shares, let's just say it theoretically, and they pay a dividend. So this is the profit that this company makes. They are giving that back to their shareholders. Apple's, for example, Apple's is currently at just under 1% of the stock price, and I believe they pay somewhere around the $3 mark per share. So if you owned 100 shares of Apple, you would get $300 in dividend payments yearly, paid out quarterly. You can reinvest those dividends back into more Apple shares to then pay you more dividend in the future. Growth stocks, now this is primarily for people who are looking to make gains on companies as either steady or rapid or good growth. So it's currently not making any money profit-wise. It's not making a profit, but it is making huge leaps and bounds towards that profitability. It is also a massive disruptor of a company. It has there's a lot going on for it right now, and so the share price, as you probably have noticed, if you're looking at this video, you've probably seen Tesla on the news as a huge growth in the last 6 months. It has gone from $188 to, I believe at the moment it's sitting at about $510. So there's a significant amount of increase per share. One of those great companies that would be probably a great investment for the next 5 to 10 years is that $500 per share may become, well, as some analysts have predicted, to become a $1 trillion company in 10 years. The share price would equate to roughly around $6,000 a share. Now, that is a fantastic return on investment, almost a 10 multiple, a 1,000% return on your investment in 10 years. Now, obviously, that's not a guaranteed thing. That is just purely speculation, educated speculation, as they're increasing their deposits into their brokerage account to allow them to buy more shares, to allow it to grow further so that they make a good return. They would be able to pull that out at one stage and use that money for either retirement, home purchase, which I know is a really hard thing to do in New Zealand right now, as obviously the average wage is incredibly low in comparison to the Auckland house price of I believe it's $1 million for the average 3-4 bedroom house with 2 bathrooms. Obviously, you don't want to put your entire life savings and all your expenses into that into your brokerage account, you want to make sure that, so you need to make sure you have a buffer, essentially. So most people in the investment world, as Warren Buffett, a famous investor, probably the most famous investor, said, cash is king. You want to have at least, I would say, and most people do, 20 to 30% of your portfolio, so your investment value, as liquid cash. So that would be something that you would actually have in a savings account. So let's say you have, for example, $10,000 and you want to invest that money. Well, you'd put $3,000 into your nice little savings account, which is nice and sturdy. It's not going anywhere. It's not protected against inflation, but it's there for if, well, life throws curveballs at equities or index funds to get a good return over that 5 years. Well, in New Zealand, site nowadays, it's all digital, that allows you to load a balance and then buy shares through their website, and you will be able to top that up and rebuy more shares, and so on and so forth. A lot of American stockbrokers have fantastic brokerage websites, Robinhood, M1 Finance, Fidelity. They have great systems in play, and they're much more ahead of the game than a lot of the international players. But unfortunately, a lot of these websites are locked to American citizens or residents. However, one of the reasons why I've started to make this channel is because in New Zealand, we have actually been given the opportunity to freely and will easily, because I know a lot of people out there who do this have no idea where to start, is that we actually have a fantastic new brokerage that I'm currently with called Hatch Invest. Fantastic job of marketing it to the universities, to finance students, to allow them to experiment with it and to use it, and it's got fantastic reviews from our New Zealand's media and what it actually offers. The fees are very reasonable in my opinion. Definitely recommend if you're a New Zealand citizen and you want to get into the market, the stock exchange, the US stock exchange, to invest good money into it, as the US economy is, though it is critiqued ferociously. It has always been on the uptrend since time began, really, since the market opened. So it's a fantastic opportunity for long-term investments, especially if you're looking at the 10, 20, 30-year mark. So I definitely recommend that. What to invest in? There are two main things you can really invest in on the US stock market, if that's what we're primarily talking about. Most markets, in fact. There are individual equities or companies, like Apple, Tesla, Amazon, Facebook, etc. Google, which is Alphabet, is their company. Or you can have a look at ETFs, which are basically index funds. Now, what they are is a company has collected a bunch of different companies in a sector, or like an industry sort of like thing, so tech one, let's say, or Amazon, Facebook, or your FANG stocks, your top tech stocks. They put them all into a collective portfolio called an ETF. And what you do is when you put money into it, it runs on sort of like if that whole sector is slowly progressing upwards, and those stocks go up and down, at different rates, and it will go up on a nice steady rate or go down on a nice steady rate. So it doesn't have as much dip highs and lows. It goes more steadily along with economic growth. It is overall just a less risk averse assessment, but you're not going to get as good a return. But it's great for people who want to get into the market and start investing. But obviously don't want to put all their money on the line or do super large amounts of research into a company they want to invest in. They want to go, well, I believe that technology is a really great sector. It's always going to be there. It's fantastic for potential to make gains on it, and so I want to put most of my money into that. There are lots of different ETFs. Lots of them have different amounts of companies in them. Some, there's the S&P 500, which is the 500 top companies in America in one whole thing. Tesla being one to be put into that. So there are lots and lots of different things you can invest in. Now, companies are a little bit more risky because obviously if a company goes down the gurgler or goes towards bankruptcy, which very, very, very rarely happens, most of the time they will either find some sort of level of support, or they may downsize themselves, their operation, but they usually will go, or they'll get acquisitioned by another company and to use their own assets. So you're usually quite safe in the long term. But obviously if you're looking at the short term, things can go down, and the best thing to do is either look at buying more at a cheaper price, or just leaving it. You don't sell. It's mainly the whole long-term thesis. Long-term investing thesis. Now, Obviously, when you invest in these companies, you have to know what you're looking for. Especially ETFs can be a little bit easier because there's a very popular one, the Vanguard series and the IBM. But if you're looking for companies, you need to do your what we call due diligence. So you need to do your own research and your own opinions and your own surveying about what a company is, what it does, what you think it's going to do, where you think it's going. Do you think it has a place in the future? Do you think it's going to be big, vibrant, like Tesla? I'm personally incredibly bullish on Tesla. I believe that Tesla is going to be a fantastic. I think it will, in the next 5 to 10 years, be a $1 trillion company. So I believe that that as that particular point of analysis, that's one of the reasons why I invest. Only one of the reasons, but one of the large reasons why I invest in that company. Now, due diligence can be quite technical. There are lots of different ways you can analyze a company. Firstly, there is a fundamental analysis, and secondly, there is the technical analysis. There is a technical analysis. The first fundamental analysis that breaks down into two. There's your qualitative and your quantitative. Your qualitative is your thesis, your idea, your concept of what it's doing, its competitive edge as a company. Like Facebook, it pretty much dominates the social media aspect. It owns now Instagram and WhatsApp. It acquisitions, it dominates it. So some people argue it almost monopolizes. However, it is by every means a really, really great company that makes a fantastic net income increase and is doing well and has a lot of potential growth ahead of it. That would be your qualitative analysis. You're looking at the less numbers and more theoretical sort of like, what is the company, what is it doing, what you want it to do, what you think it's going to do, etc. So Tesla's a great example. Even though it doesn't make any profit, and its balance sheets don't look like it's in the greatest position as a company should be to like climb the ladder of the stock market, it still has a lot of potential growth there because the qualitative fundamental analysis of that company looks so bright and rich that a lot of people go, I don't care if it's not making a profit now, I want in now. A lot of people may have thought that same way about Apple back in the early 2000s before the iPhone was released. They would have gone, this company with Steve Jobs has so much potential. It may not be making a lot of money, but it could because of the way they're going and the products they make are fantastic. Same idea. The next is your quantitative. Now these are numbers. You need to look at the balance sheets, you need to look at their earnings reports, and you need to look at how much money they're making, how much it costs for them to do stuff. It's very, very easy. I will probably do a YouTube video on how to do a quantitative analysis on a company. Just a really brief, easy one, so people can be like, oh, an earnings reports come out from the company that I've invested in. I'd like to go look at that, and you would be able to look at the key elements to go like, okay, well that's improved, that's not improved, and then maybe do a bit more due diligence on why that hasn't improved, and you can make your investment decisions on those points. So that's basically the fundamental analysis. A lot of people just invest on that particular part of the analysis. The technical analysis is all about looking at the charts, learning about how charts move, and ignoring everything else, and just primarily looking at charts to find entry positions and exit positions so buying and selling. Honestly, it's not as important. People love to do it. There's a huge cult following around the technical analysis. I've looked into it myself. Its only real reason is a great time is if you're trying to get in at a really good value investment. So you either try and get in at the lowest possible price without the actual price being, detrimental. That price movement is not a detrimental cycle in the company's business. It is more just a sell-off period, and there's a low price margin, so it's good value to buy at that period of time or to keep buying. It's realistically not that important as a long-term investor, or people like who are probably just your day-to-day want to just make sure that their savings give them money, or they're looking to save for a house in the next 5 to 10 years, and this might be one of those solutions for them. In fact, I would say that it's probably one of the only solutions currently to do so, especially if you don't have a super high-paying job, Now, I hope that's really helped with kind of where you want to go in the stock market. So that sort of a very broad and basic explanation of what things are, how they work, and what you're looking for. Now, the last thing I'd like to touch on is tax. Now, I'm not going to talk about exact percentages and numbers here because it can differ between country to country to country, but I do know the general rule of thumbs that would work. So there's no tax unless you sell. Now, if you sell a stock at a higher price and you make a profit on that particular price, so obviously if you buy something $100 and it goes to $200 and you sell it at $200, you've made $100. Now you only will have to pay a capital gains tax on that, and most countries, this is speaking for most, only have to pay that if they've held the stock for longer than 365 days, so a year. You won't actually have to pay a tax until you sell it. So if you hold on to Tesla for 10 years and it times 10, 1000% in value, you will only have to pay tax on that gain at the point of selling the stock. And because you've held it for a long period of time, because that would be what they call a capital appreciation or a capital gain. So you're increasing your equity, essentially. Now, your dividends, if you're investing into dividend-based companies, get companies that don't grow a lot, but they grow very steadily over time with economic movements, and they primarily you're investing in them for the money that they pay you every quarter, so that you can create kind of like a passive income or a buffer or increased income for retirement, etc. They will tax that. Now the great thing about Hatch is that they actually tax your dividend payments through the US as they get paid to you directly into your brokerage account. Now this is for our New Zealand broker that I was talking about earlier. Now the great thing about that is that would provide you with what we call tax credits. Now tax credits will get paid, or you can use those tax credits to, when you do your big IRD tax return sort of stuff in New Zealand, you can use those to reduce the amount of tax that you get paid or get a tax return on that. Now there's also another law, which I do know there are specific limitations to it, but generally the rule of thumb is if you sell a stock at a loss in the financial year, it is a tax deductible loss. That obviously there are very specific limitations to that. That is just a broad sort of concept. I definitely would recommend looking into that further. I might deep dive into these things in later videos if people request that. This is obviously the first video of the channel, and I hope I've answered most of the people's questions. If you have any other questions, down in the comments below, please. Tell me what you think. Something new I'm trying at the moment, hoping to maybe expand on this, maybe weekly videos. I don't know. We'll see what happens. Still got to do study, so on top of other things. Well, I hope you guys have a great day. Hopefully we keep this bull run of a market going all the way up through the next 10 years, and we'll see you next time.